That's it. Say goodbye to February. You know, I'm not a big Billy Joel fan, although I have seen him in concert. Say Goodbye to Hollywood is my favorite Billy Joel song, but it's neither here nor there. This is Market Call. It's 1 o'clock. You just got Dan, Nathan, and yours truly today. This Market Call, Dan, brought to you by CME Group, where risk meets opportunity. And of course, FactSet Financial Data and Analytics, powered by Tomorrow. Of course, they're our data provider as well. A lot going on. We're right around hockey trade deadline Friday. As you know, spring training in full bloom. Looks like Anthony Volpe really wants to make the big squad out of spring training. We'll see how that plays out, Dan. How are you?
I'm doing well. Guy, the first vinyl that I ever had came in 1980. It was Billy Joel Glass Houses.
Sure.
What would have been your first vinyl?
I will tell you my first vinyl, I believe, was Led Zeppelin 4. I gotta think that was like 1973, 74-ish, because of course, as you know, Led Zeppelin 4 contained, amongst many songs, Stairway to Heaven. Boston's first album was also up there as well.
Okay, fair enough.
And the Cars, by the way. I mean, we're really once you do this, you know I'm going down a dark place.
What about your first cassette tape that you got?
Good call. Meatloaf was probably, it was an 8-track. It was probably Bat Out of Hell. Street Survivors, another album that I bought. I believe that was 1977 in October. Obviously, that album was released on October 17th, as many people know. On October 20th of that year, 3 days later, the plane containing the members of Leonard Skinner and their crew crashed in Gillsburg, Mississippi. Now, I will tell you, this is not rehearsed, folks. So the fact that I was able to pull Gillsburg, Mississippi out of you-know-what is remarkable. Really.
If we are rehearsing this, we gotta rethink the whole thing. Mine was Synchronicity in 1983 by The Police. Okay, moving on here. And if you are at all confused by that conversation, then you might kind of fall in the same camp as Guy and I are. When you think about the data, Guy, the economic data that we've been seeing that actually has been moving the markets around, it's kind of been a little bit confounding. You know, you say this all the time. I've heard you say this for 10 years, that consumer confidence is really an overlay of the S&P 500, right? Well, you saw that consumer confidence data out this morning. It wasn't great. The S&P didn't love it at first, but doesn't seem to be bothered right now by it.
Not at all. And when I say that, what I effectively mean is, and if you give me a second to explain, I've come to the belief that although, and I'm not suggesting everybody owns stocks, and by no means am I suggesting that people watch the market as closely as we do, but I think when I say that the stock market and consumer confidence is sort of an overlay of one another, what I mean is, you know, as long as the stock market does okay and there are no hiccups, people look at that, they say, well, the stock market's doing well. I guess that means the economy's doing well. And my neighbor just bought that Mercedes or Prius or whatever he or she bought, which probably means I know what he or she makes. I can buy the same thing. And that's really what it is. I mean, people sort of go on their merry way. But when there's an episode in the stock market, like we saw obviously in 2018 in the fall, well, we saw it obviously in March, April, May of 2020, that's when people take notice. And that's when people say, wait a second, what's going on here in the stock market? Maybe I shouldn't be buying that car. Or maybe I shouldn't be buying those Starbucks $8 lattes. And it sounds somewhat preposterous, but I will tell you, when people view the stock market as a problem, they start to address whether or not they should be spending money. So that's why I make the comments that I do.
No, I mean, it's a fair one too. You know, right now, I just think there seems to be a whole heck of a lot of uncertainty, obviously about the economy, about the course and how long the Fed is going to stay as tight as they will. And we talked about it, I think, earlier on, or over a few times over the last week, is that, you know, David Rosenberg Research, I mean, he keeps kind of pounding the table, and we have a little bit of his morning note this morning about just how strong the economy is, and again what the Fed is likely to do to that strength. And so it's just kind of interesting. I love this in the context of the softness in the equity market of late. This bounce attempt was pretty feeble. There were nearly as many decliners as advancers. So he's talking about the breadth here is not particularly great. But this comment here, construction, manufacturing, and retail alone look to be overemployed by 2.6 million workers based on real construction expenditure, industrial production, and retail sales. So to me, you know, he's just basically saying that we need to see that unemployment number tick up, and then you might see the Fed take their foot off the pedal a little bit, and that's the final piece of this economic puzzle here.
Yeah, and it's interesting. I think Julie Beal on Fast Money, I think last week, alluded to that as well. These construction jobs, how quickly they come and how quickly they can go away. I just want to address something John Barrett, Jacob, pulled this up. Guy from yesterday, it was Miley Cyrus singing Wrecking Ball, not Taylor Swift. So clearly John's not in on the joke, and
Nope.
which is fine. I will tell you folks that I've been making that gag for years now since the song came out. First of all, I don't give a shit who sings the song. I don't know the song from a hole in the wall, but I find it funny that I can quote that song and infuriate half the audience thinking that I don't know who sings it. Quite frankly, I don't really care who sings it, but back to you, Dan.
Yeah, well, and he also, the other gag, and I'm doing in quotes here, people, is like when Drew Barrymore's name comes up, he talks about Close Encounters of the Third Kind or something, or Star Wars.
When I just say I love her work in Star Wars because it's another shitty movie that everybody raves about. Oh, I love. No, you don't. It's just it movie sucks.
Guy. All right. Here's one from Cameron Dawson. I think this is pretty good. She's at New Edge. She's been on our On the Tape podcast on a couple of occasions. This is the Russell 1000 growth versus value. She's saying, tweeting this morning, the message from this chart: be careful confusing mean reversion and trend change. Big outperformance of growth over value to start 2023, but we've rallied right to resistance, the 200-day moving average, and stalled. Though it is notable to see growth hold in so well despite the surge in yields. And you and I have been talking about that a lot. I mean, we have, I think it was Liz Young tweeted this morning that, the 10-year U.S. Treasury yield guide is on the doorstep, she said, on the doorstep of 4%. And I really do feel like if it is able to overtake that and then really kind of establish kind of some new ground above 4%, I just think that's the thing that has to start weighing on higher valuation growth stocks. And that's why I think this is a really important tweet from Cameron. I guess it does confirm some of my beliefs, but it's also one of those scenarios where I think it could be really true, and especially if rates kind of overshoot to the upside.
And she's been on Overtime a number of times recently, and she talks about valuations being stretched here. And I think she is anything but constructive on the broader market. And I think that chart is interesting, and so is the quote. Don't confuse mean reversion with the change in trend. I mean, that's something that Carter Worth talks about all the time. And I think what we've effectively seen here is mean reversion, but the trend to the downside is absolutely still intact. You look at that chart and you see a series of lower lows and lower highs. You see a very well-defined double top, and it appears as though we're sort of stalling right at that moving average. So I think that's spot on. And, we're not trying to be dogmatic here and just sort of pull negative stuff that we find. By the way, as you know, and I'm going to sort of tease this out, Tom Lee, a noted bull in the market, will be joining us on the On the Tape podcast this week. Drops in your favorite podcast store on Fridays. So for those that say you only surround yourself with like-minded individuals, think again there, peeps.
Yeah. All right. Let's bring up the S&P futures here, the E-minis. And I think this is a really kind of interesting chart, Guy. I mean, I have, a bearish trade in the S&P in puts, okay, in March expiration. I also have one in the QQQ, the NASDAQ 100. But if I'm looking at trading the futures here, this one's a kind of interesting setup here, man. Like that low that we made, 2 trading days ago, look where it caught that support. Okay. If we're looking at the E-minis here, and you don't really need, it's not particularly scientific. It was right at that 200-day moving average. You see the 100-day moving average that's sloping higher. You see right here in around 4,000. Okay. That is the 50 days. So you're seeing this kind of cluster of support from the moving averages. You've seen this drawdown from 4,200 down to 4,000. It's still in a bit of an uptrend, Guy. It's contending with that uptrend line just from a purely tactical standpoint. When you think about, after this week, we're going to be through 90% of S&P 500 earnings. What's got to give here? Is it all about rates? Is it all about a dollar that's firmed up? Is it all about an increasingly kind of murky geopolitical situation, which a year ago this time caused a lot of palpitations in global risk markets?
All right, so let's talk about rates first. You mentioned the 10-year. So I think if in fact, and it just seems a foregone conclusion at this point, but let's say it happens, we get that 4% print in 10-year yields, you can almost see the headlines. 10-year yields top 4% for the first time. All the different shows will be leading with it. That will be top of mind in the market. And I think just changing big numbers will give people pause, or at least something to think about, number one. In terms of what changes the tide here, or what sort of triggers this thing to hold and bounce or trade through it, here's as a trader something, and we'll bring it up quickly. You know what? There's a myriad of different answers. Obviously, I have a bit of a negative bias here, and I think the headwinds are still significant. I think the valuations are compellingly expensive here, which means the market should go down. But if you're ambivalent and if you don't have a view, let this sort of charts make the decision for you. Assuming you think this chart is reasonable, you can stop into a short position with futures. What does that mean? For example, if the S&P closes below, or the mini futures close below 39.25, let's say, you stop into a short position. You basically cover that position, maybe on the upside if we break through and close above the trend line, and you're looking for a move probably back down to the lows we saw in, I don't know, early Jan, and then subsequently the lows we saw in October. Conversely, if we hold here, you can say, you know what, I'm going to put on a long position. I'm going to stop out on a close below the trend line. And on the upside, I'm going to look to let it run, and maybe we visit the levels we saw in August. So that's the way I would look at this chart. So you understand what I'm looking at in terms of the fundamentals. I think the market's expensive. I think there's significant headwinds out there. These 210s inversion continues to go the wrong way. 10-year trending up to 4%. Layoffs continuing to happen in a myriad of different industries. They're all out there for everybody to see. But in the meantime, you can say, you know what, I don't really have a view either way, but that's how I'm going to trade it using the parameters that Guy just gave me.
Yeah, and I guess if I'm looking at the E-minis here at 4,000, I'm basically saying, you know what, I'm going to stop myself if I want to play from the long side at like 39.50. That was the low on Friday afternoon, or just below that, and then I'd be looking for a move up to 41.50. So I'd be risking 50 to possibly make 150 if that's my targets. And again, to the point you just made, you can use stops there to kind of cut your losses. I think 50 handles on a 4,000 S&P might be kind of wide right here. So you may want to tighten that sort of thing up. You want to take small losses on these sorts of positioning. Let's look at the NASDAQ here really quickly, Guy, because, this one, again, is also sitting on its 200-day moving average. It's sitting on that uptrend from its January lows. It's a bit more off of its recent highs here. It was just above 13,000. And here we are. That 200-day is it's about 12,000 or so. This one is really interesting to me because I'm looking at the market today, and I feel like even though Apple and Microsoft and Google, they're all up a little bit. Amazon, they feel a little heavy. I mean, Google's got a little bit of a bounce here, and I am of the belief that when and if the market were to turn it, I'll throw Tesla in there on the heavy camp. It's down, actually red on the day, which is not something that's done in a little bit here. I feel like those are going to be the leaders to the downside. And so to me, that's where I'm kind of placing some of my near-term bearish bets. But by the same token, I think we're at a point where it literally is, up or down 200 points in the S&P 500, and it feels a bit like a coin flip unless there's something out there lurking, some sort of tape bomb, Guy.
I think that's exactly right, and I think you're right to point out although these stocks are up marginally, they're clearly starting to lag, and the ones that you mentioned, which leads me to believe the only thing probably holding this NASDAQ E-mini is, to the extent that Tesla is even important, is probably that. So we'll see. We obviously have an event tomorrow, but Microsoft, which had that huge move post earnings from 233 up to 275, that seems to be headed back to more reasonable price levels. Apple traded off that 125 level pretty violently. That seems to be coming back down to earth, and it makes sense that it is. And Amazon, quite frankly, hasn't really traded all that well in years. Google, we talk about all the time. So the pieces are in place for this uptrend that you drew to fail. And again, looks eerily similar to the S&P minis. I get it, but that's why I'm looking at this. Real quick, Dan, George Bruton says the VIX for May, July, and I didn't see this, but 100,000 calls, 50 to 75, bought by trader, this 50-cent person who I have no idea who he or she is, but he's saying, is that a play on USA default? I have no idea, and I didn't see it. Maybe you can speak to it, but I have heard of other people buying way out of the money VIX calls recently. So maybe there are people out there that sort of see the same thing we're seeing.
Yeah, no doubt about it. And again, on the VIX, I mean, if you look at the thing, we see that there's, pretty decent support in that kind of 17 to 18 level. And that has obviously been a pretty good spot when the VIX has gotten that low to maybe take some profits in stocks, and vice versa when we see the VIX up above 25 or 30, really above 30. It's been a good time to buy. It just feels like we are in a different regime right now, guy, as it relates to the markets here. And again, this comes back to yields. We'll just hit this really quickly. You see that I think we're as high as 3.95 earlier today in the 10 years. So let's see what happens at 4%. And really, it comes back to what the Fed's going to do. The CME Fed Watch tool here, if we're looking at the May meeting at this point, I mean, there's a very strong likelihood is that we have a 5.25 upper bound on Fed funds. And maybe there's even a 25% chance that we get 50 basis points. I mean, so when you think about those probabilities, what is that saying to you about where inflation is? That whole idea of people got all geeked up at that last meeting, how many times they were counting that Fed Chair Powell
13.
Said, 13 times disinflation. And this goes back to, I think, what Cameron was saying in her tweet this morning. I mean, let's not confuse a reversion to the mean, right, to a change in regime. And we might just still be in that pesky and persistent regime that you have been on for a year, Guy.
Yeah, well, we coined that a long time ago, talking about it wasn't peak, but there were two other words that we used that started with PE, and that was pesky and persistence. That's proven to be correct. So what do I think? Well, Bullard talks about, 5 3/8. He sort of pulled old school out. So 5.375 as the upward bound. A lot more of these talking heads on the Fed side of thing seem to be coming around to that way of thinking. And again, Liz Young talks about this all the time as well. You're hard pressed to believe that we're going to have a conversation in the months to come that, hey, guess what, folks? We raised rates at a historic pace, 500 or so basis points, and nothing happened. The market was fine. The economy was fine. All those things were fine. We're just going to go on our merry way. Like, I just don't see that happening. I find it very difficult to grasp that. A lot of people are. I think the bull case is such that, the Fed is navigating this extraordinarily well. The market has not had any hiccups other than the sell-off we saw obviously late last year. But with all that said, limited damage so far. And I think people are taking solace in that. With each passing day, I think people think we're closer to the end than we are to the beginning. To your point, though, I think inflation is a lot stickier than people realize. And there are a lot of people that think that, we're trending in the right direction, the Fed using terms like disinflation. But that last print was pretty hot. And my sense is, as you mentioned a couple of weeks ago, that inflation is getting back on its horse early here in 2023.
Matter of fact, Guy, just the dollar, we hit it yesterday, is kind of firming a little bit. We talked about, just kind of that 210 spread. I mean, when you put all that stuff together, it does kind of make for, in my opinion, a bit of a nasty cocktail for stocks and for valuations. But let's see, they don't seem, again, I'm just going to keep saying this, too bothered. Right here, real quickly, Guy, on this crude chart, you could draw this kind of downtrend however you want here, but that little uptrend that it's been in caught a bit today. It's up 2%. I know that it's interesting to see that the major integrateds are down about 1% or so on a day that crude's up 2%. And then your Henry Hub, you love the Henry Hub.
Sure.
Natty gas, it's approaching a little bit of resistance, that breakdown level that was 3.25 or something like that. So it's 275. It's a bit away here, but had a really sharp bounce off of the lows. I know you're keeping a close eye on these, because if you were to see crude break out and you were to see nat gas kind of retake that level that it broke down from and maybe on its way, I've seen some kind of bullish reports for nat gas saying that maybe you see this sort of spike because of the supply demand dynamics and some of the geopolitical stuff and just the kind of dragging out of the war and the ineffective nature of the sanctions, I guess, on Russian oil and gas, that maybe you could see another spike here. Thoughts really, really quickly on that, Guy?
Yeah, well, it's no longer a weather thing. So it's not, these are not bets on a cold front coming through. Now it's more of a bet, to your point, about supply demand imbalances and some of the fundamental things that are going on in natural gas. And look, I thought it got way ahead of itself on the downside early in 2023. That proved to be incorrect. But like so many other things, it seems to be getting back on its horse now as well. And I do think I've read the same things that you've read, making a very bullish case for nat gas in the back half of this year. I'll tell you, for a lot of industries, the biggest input they have in terms of inflationary items is natural gas. It's a huge input for a lot of the manufacturers out there. So it's something absolutely to keep an eye on. And I do think nat gas has some room to the upside. We're a couple headlines away from seeing this go from a 3 handle to a 4 handle. And we've seen that many times over the years before in terms of natural gas. That's why they call it a widowmaker. I'd be playing it from the long side. In terms of crude, yeah, back on its horse a little bit today, but it's been basically sideways between sort of 73.5 and 81 or so in the commodity for quite a long time now. I still think the stocks behave pretty reasonably well given the backdrop, and I still think energy is going to be a huge part of this year, specifically over the next few months. I do think the energy stocks will continue to perform. And real quick, Dan, because I think this is interesting. This is a point that Doug Cass makes. Somebody, I know I lost the damn tweet, but they were talking about these daily options suppressing volatility and maybe ramping up the broader market each day. I can't, and I'm sorry that I can't find who just said it. Maybe you can retweet it or whatever. There it is, Darren Ristic. Thank you, Darren. Beautiful picture, by the way. Clearly, your kids get your looks from your wife. Sorry. But that is something a lot of people are talking about right now. These single day options. Doug Cass has talked about it a number of times.
Yeah. Hey, while we're on Doug Cass, he just sent this over, and I thought this was kind of interesting because, Guy, you and I just did our Fast Money call with our producers and Melissa and the fellow panelists, and I was talking about some of these large pharmaceutical stocks and how poorly they act. And Carter was on the market call, I think about a week ago, saying how, and he had a note out on We're Charting, how unusual it was to have the XLV, the ETF that tracks the large, pharma companies, and also UNH is in there too, to be down like 8 weeks in a row. And here we are, I think it's down like 9 weeks in a row. And, Doug has a note out on his Real Money. And listen, guys, you tune into this because you like, hopefully, what we have to say. And hopefully we're trying to get a diversity of ideas and kind of thoughts in general here. Doug does great work, and he is posting multiple times a day. So check out his stuff, but he has a note out and you can get more information on it in Pfizer, Johnny John, Lilly, and a little spoiler alert, he's calling them value traps here. So that's a kind of an interesting one, again, because if we're on a risk on sort of mode, the outperformance, the rotation that we saw into this space late last year, you know what I mean? As we saw some growth names really kind of just fall out of bed. And maybe that was some tax loss selling or whatever. But Guy, how do you feel about the valuations? How do you feel about kind of him labeling them as value traps? I'm sure each one of these names, they all have their own story in their own right, but as a kind of, as we're looking at the XLV, it's below its 200-day moving average, which I think is really interesting. It's probably one of the first sectors in the S&P 500 last year to overtake it to the upside.
Well, it's interesting. If these stocks are going down, which they have been for decent period of time, it's probably because we're seeing a rotation into other things. And that's exactly what's been going on. And the rotation obviously has been into some of these higher valuation, high growth tech names. NVIDIA stands out, but there have been others as well. In terms of being value traps, I would submit like an Eli Lilly is actually expensive. I think Doug would agree with that as well. It's been expensive for quite some time. All of a sudden, valuation seemingly starting to catch up with it. Merck, reasonable, maybe at the upper end of valuation. UNH, though, you could probably make a compelling case on valuation, and that stock's been until recently a stalwart in the broader market. So the fact that these stocks have been rolling over, I think it's something to take notice of. It should theoretically be bullish for the broader market. That's somewhat counterintuitive, but if people are rotating out of those names, they're probably rotating into some of these higher growth, higher valuation names because they feel comfortable about what the broader market is doing.
All right, can these guys pull up a Pfizer chart here? Because this one is pretty fascinating. And again, this stock, with the vaccine stuff had some fits and starts. And if you bring it back to kind of, the start of 2021, it's pretty remarkable, when you saw, the vaccine announcement, the stock was, I think, around 40, Guy. It went to 50, pulled back all the way to the low 40s, then made a new high above 60 in early 2022 when the vaccines were and the boosters were like kind of full effect and shipping. I mean, that is pretty astounding. And then if you look at it on a multi-year basis, right back here at 40, I mean, it is back where it broke out after that announcement. Is that fair that the stock round tripped that entire move, in your opinion?
Yeah, Pfizer has its own issues. Clearly, their pipeline is probably, if you measure them up against some of their competitors, I mean, they're nowhere near where they should be. And it's been sort of mired in, it's been mired at this range seemingly for years. If you were to broaden that out, you'll see that Pfizer's effectively gone nowhere in a long time. And in my opinion, this is not to pick on Pfizer, and you can see as we continue to broaden out, what I'm talking about. But, they sold their consumer products business 12, 13 years ago to Johnson and Johnson for about $16 billion, which seemed like a score at the time, and it proved to be a score for J&J. They diversified away from one of their big profit centers, and it really came back to bite them in the you-know-what, Dan, ass that would be. So here we are at the moving average level. I guess it's interesting, but you look at this chart, I mean, series of lower highs, series of lower lows, they are bringing up the rear. They're what we call an after-ran in terms of their competitive landscape with the rest of big cap pharma.
All right, let's look at another sector that's obviously been very volatile over the last few years with the pandemic. A lot of weird stuff went on in the housing market. And here's Carl Quintanilla. You call him CQ.
CQ.
He's the man. He's quoting an Apollo report here that has a few charts. And it says the housing market is starting to rebound. The risks are rising. That expected strong rollover in the shelter component of the CPI index may never happen. So talk to me a little bit about this, because we were on Fast Money the other night, and I generally like to keep my 2 cents out of things that I don't have like really strong feelings about, or probably not like a great background in. And housing is definitely sort of one of them. And I can't remember whatever. I had a one-liner to Courtney Downing on there, and you just like just were like in the face. Whatever she said back to me, she just kind of shut me down.
Courtney Garcia.
Courtney Garcia. Well, isn't she Courtney?
I can't speak intelligently about her maiden name, but with that said, so here's the takeaway from this. This just illustrates what we were talking about before in terms of pesky and persistent. This tweet makes the Fed's job that much more difficult because they need housing to roll over. It's not happening. And if rents and the components around housing continue to stay firm, it just makes their job that much more difficult. And I encourage you to go back. It's probably late summer, early fall. Jerome Powell was doing one of his press, whatever the hell he was doing, and he fielded a question. And then before he got off the stage or the dais, he said something to the effect, and I'm paraphrasing, "Oh, by the way, if you're a millennial, I would think twice about buying a house," which really struck me as odd for him to say. But it speaks to exactly that. I mean, housing is a problem for them. The rent component, the housing cost component of this whole equation does not go away. And that's going to make their job really effing hard.
Yeah, well, I mean, listen, Guy, it speaks to this no landing situation where, which is better than a soft landing here.
Yeah,
maybe
it's
unemployment
bullshit.
never goes up.
Why you'd see? I woke up in such a good mood, and
Guy, but maybe they took out a lot of the excess in housing. Maybe they took a lot of the excesses out in some of these other kind of risk markets here. We had a down 20% year in the S&P 500. That was correction for all the ills of just kind of bad monetary and fiscal policy over the last 13 or so years here, and that's it. We're off to the races. It's a new bull market, and it's a new bull market with Fed funds at 5%, Guy. So get used to it, buddy.
Yeah, it could. Listen, I mean, that's going to be what you just outlined, somewhat tongue-in-cheek, is going to be the bull case for a lot of people that, when this new paradigm, the market's figured it out, we can adjust to these rates. We're not going to have a significant move in unemployment that's going to stay probably somewhere between, 3.7 and 4.1%, which is still historically on the low end of things. Housing's not going to crash. And we've managed to sort of navigate this thing and thread the needle. That's fine. And that's a great argument, I guess. I just don't, for the life of me, don't see it happening as we continue to sort of go down this road. I don't think the market has nearly taken into consideration the lag effect of raising rates the way we have over the last year and a half. As a matter of fact, Julian came on last night and sort of echoed a lot of things I was saying. The reason why is because there was so much stimulus money sloshing through the system. That seems to be coming to an end. And I think we're at the precipice of starting to feel the effect and the impact of a rising rate environment. And I don't think it's going to be particularly pretty.
Yeah, well, the stock market, again, this is going to be the third time I say this, does not appear to be too bothered by
phased.
All, Guy. It just doesn't. Listen, and, I'll just say this. I mean, you and I, we're not here just to kind of bet against the market or bet against individual stocks or whatever. And I think that last year, we kind of kept re-upping that stance because it felt like the right thing to do. And this year, just really from a price perspective, we're 2 months in here. And, again, it seemed like you could have thrown a dart in late December at anything on your main fact set board, and you could have made 20-30%, right? If you bought the stock in which that dart hit. I think it gets a lot harder from here. You know what I mean? Especially when you consider the fact that, okay, we just got through the bulk of Q4 earnings here. And let's say for the most part, it wasn't nearly as bad as people expected. We've been quoting John Butter's work on Earnings Insight from FactSet, how the numbers have been coming down all quarter, right? And we also know that analysts and strategists generally overestimate, 1 year out earnings for S&P 500 companies in their totality by nearly 8% or so. So they're going to continue to come down, especially as you have higher rates, higher dollar, and higher inflationary reads that are just going to start picking up a little bit from where they kind of ended last year. So all that gets tougher. But again, and this is going to get you triggered right before we get out of here, markets, and this is what people say to us, if we're just going to be stubborn here, they climb walls of worry. And that seems to be what they're doing. If they were to rally back to 4,200 guy in the next few weeks or so, they'd clearly be doing that in the S&P 500. But when you look at that chart of the E-minis here at 4,000, right at kind of critical support, the uptrend of the 200-day moving average, I mean, literally, it's 200 points away from the high it made earlier this month. And it's 200 points away to the downside of the low right before, it took off in early January.
Yeah, and you make the points you make are tremendous. The markets, and I've never used that term, and I'm not going to start now. But markets typically do grind higher in the absence of news or any catalyst. They're going to do the grind, and that's what we're seeing now. Rainey says end of the month markup there. There's probably some of that going on as well. As we mentioned at the top of the show, this is the last day of the month, so got a lot of interesting things going on. But the reality of the situation continues. Earnings are coming down, and the market's expensive historically on valuation at these levels with rates where they are. And that's really what it comes down to, forgetting about all the geopolitical headline and risks that are out there that we didn't discuss today, but we've discussed before. I mean, there's a myriad of things to be concerned about. But to your point, on days like today, when the market seemingly has reason to go lower and starts to grind higher, it's just one of those, if you're in the bear camp, it's one of those frustrating days that you just tolerate and move on from.
Well, I'm tolerating, Guy. I'm tolerating. All right, listen, that was a lot of fun. Thanks to our fine sponsor, CME Group. We love those guys. Where risk meets what?
Look at you.
Where risk meets what?
Where risk meets opportunity. Sort of they meet. It's the Laird Hamilton. He checks out the wave and then he rides the wave. His risk is meeting the opportunity.
You know where I love CME days, because when I started the business in 1997, I probably told this story before. One of the jobs I had on the trading desk that I sat on is that I had to have a phone on my shoulder, basically quoting the S&P 500 futures to the guy that I worked for all day long. I mean, all day long. And we had our broker in the pits at the CME, and we actually went down there and traded one day from there. It was a total disaster because at the end of the day, I think you do need your FactSet machine in front of you when you're trading and you're using the sort of inputs that we were using. But to me, it always brings back good memories, and I loved trading the futures then, and I still like trading them now. And I like talking about using stops. You actually used a great scenario where stops make a whole heck of a lot of sense, especially when you're trading index options, and especially if you're doing it intraday, Guy.
I love it. We watched last hour of Trading Places on Saturday night at like 11 o'clock because why not? It's one of the great movies. They filmed that scene on the exchange on a Saturday, and all those traders you see are actual traders from the COMEX and the NYMEX back in the day. I know a lot of those guys and gals. But that's it. As Dan mentioned, thank you, CME Group, where risk, in fact, meets opportunity. Obviously, FactSet for being our data provider. Dan is back tomorrow with the great Carter Braxton Worth. I will be in parts unknown, otherwise known as Naples, Florida, for the day. But I'll be back on Thursday with Dan and EY from SoFi. And we're going to a hockey game Thursday. It's a busy week.
We got a lot going on, buddy. And we got Tom Lee. He's going to be on our podcast on Thursday. It's on the tape podcast wherever you find your podcast. It's going to drop Friday morning, so check it out. And also, guys, if you're on here and you've not subscribed to our YouTube channel,
how is that possible?
You can just watch it.
Well, they should just pound the subscribe button.
Well, smash it, pound it, do whatever it is that you do to subscribe buttons, and we'll see you tomorrow. Guy, have a nice day in sunny FLA tomorrow. See you later.
Later, folks.